Now to the tax implications of the budget. Many are calling it one of the most significant tax reform budgets in decades, with sweeping changes to capital gains tax, trust structures, negative gearing, and the taxation of investment income. Supporters say the reforms are about fairness and housing affordability. Critics argue they fundamentally change the way Australians invest, build wealth, and structure businesses. So what was actually announced, and what does it all mean for investors and, importantly, business owners? Joining Nick Schillberger to unpack the tax implications of the federal budget is Michael Jones, partner at Forvis Mazars. Nick starts by asking Michael about the government's announcement to replace the 50% capital gains tax discount with cost-based indexation.
It's from 1 July 2027, so there's a bit of a way before it starts. And at that point, the 50% CGT discount will be replaced with a system that adjusts the assets cost for inflation, which we used to have back in 1999, and that's just called an indexation. But another really important change is that there's a minimum 30% tax on capital gains tax after 1 July 2027. So instead of halving the gain, which has been the case for, decades, the purchase price will be adjusted before inflation, before calculating the gain and then subjecting it to tax.
Is it going to be more complicated to calculate than a simple 50%?
Perhaps. It's just that you're going to be paying more tax. This is a really significant thing. You watch debate and the language is about clamping down on the capital gains tax rate. And it's very biased language, because the idea that you tax income and capital the same is really nonsensical. One, with capital, people make investments, there's risk, there's a long term before you get a return if you do. And besides that, you've already paid tax on the money and then you invest it, right? And then to tax it as income is, I think, misguided. So the calculation is not the issue. It's just taxing capital gains without understanding the consequence, because I think it will make a difference to investment and it will make a difference to innovation in this country.
Now, you mentioned in passing there that the capital gains are also going to be subject to a minimum 30% tax.
Yep.
Is that going to be significant in practice?
Yes. And it will also include pre-CGT assets, right? So that if you acquired an asset before the introduction of capital gains tax in 20 September 1985, that asset's been not subject to capital gains tax. That's now changing. Well, 1 July 2027 it'll change. So it's 30% minimum, but it'll be up to 47. So
yes.
I'll give you just an example that's not too fanciful. And it's about, the biggest one is for startups and innovation, So if someone starts a company, they've got a nominal $2 cost base. It's all about their effort and their brains and their creativity.
Start with nothing.
Start with nothing. Build it. And these are our clients. We have people that do this, and it takes decades. And then if everything works, they sell for a lot of money, but it might have taken them 20 years or more. Anyway, sell for a lot of money, the indexation gets adjusted and they're taxed at 47%. That is, I think, a real issue in this time of innovation that we're living in this time where we want more productivity and creativity. And there's an appetite for people to be doing things and being more hands-on. That's one side. Will it help housing? I don't know. Maybe it will, and maybe that's a good thing. But at what price? At what price to the Australian community? So, yeah, it's quite a shocking change.
Yeah, the focus of the budget's been about investing mainly in property and in shares, but it's that investing in business that we don't want to discourage as a country.
We really need it. And the language is about rewarding workers against others. And I find that an unhelpful way to frame tax reform. So winners and losers. We'll all be paying more capital gains tax. Winners, I guess you could say, if you already had an asset that you've owned for a number of years, that'll be taxed at using the discount up to 1 July 2027. You may not feel like a winner, but relatively you're a winner. The other winner, though, just quickly, is probably superannuation, which has not had any changes in this budget. So if you've got a self-managed super fund in particular, where you can manage the assets you've got a tax rate of 10% on capital gains. And that sort of tax rate for an investor really, over the long term, enables compounding and is an encouragement for investment. And of course, if you hold it till your retirement, it's zero tax rate if your balance is less than 2 million. So I think self-managed super funds are winners, and losers is probably everyone else. And hopefully, though, there is some improvement in availability of housing.
Well, that's the hope. We will see. Another major reform is the restriction of negative gearing on residential property to new builds only. What impacts is that going to have on investors and housing supply and also property prices?
Let's just talk about how it works.
Yes.
So again, it's from 1 July 2027. The negative gearing will be limited to new residences, as you said, but also there's a carve-out. So if you did own your property before the 12th of May, the budget night, then you can continue with the negative gearing. But going back to that future point, it'll only be eligible for new builds. So if you buy a property after the 12th of May, you won't be able to offset any loss against your salary. You can offset it against future rent and future gains, but not against your salary. And the pre-May 12 properties are grandfathered. This is only for residential properties, and the commercial properties and other classes, such as shares, you can still do negative gearing.
So taking all of these changes into account, can I run a quick example by you?
Yes.
What if someone has purchased an investment apartment a few weeks ago before the budget, but it hasn't settled yet? So they're kind of stuck in a bit of limbo between the two. What's going to happen there?
Well, they'll end up in the winner's bucket because if you've entered the contract, then it's considered owning it for these purposes, for tax purposes.
Okay, so they're in the winner's bucket. Excellent. Moving on to family and discretionary trusts. They're now going to face a minimum 30% tax rate on distributions. And trusts have been central to many investment and business structures for decades. I think you said before, back to the 1970s.
They started popular in the 70s, yep.
So this is going to be a big change. Does it mean the end of trusts?
This is an enormous change. It's certainly the end of an era. It may not be the end of trusts, but an end of an era. And this is how we imagine it's going to work. If you look at today, when a trust distributes income to beneficiaries, the beneficiaries are taxed at their marginal tax rates. If the trust accumulates income, it will pay 47% tax on that income. And that's why generally trust income is distributed. Now, what's extremely common practice is you have something, it's called a corporate beneficiary or a bucket company. If the trust distributes to that corporate beneficiary, it'll pay either 25% or 30%, depending on the activity of that corporate beneficiary. And the franking credits that trust might have will also flow to the company. Now, from 1 July 2028, so this is now a further year out, the trustee will pay a 30% minimum tax on the taxable income, including capital gains, right? The beneficiaries that receive that income, individuals, not a corporate is separate, we'll come back to that. Personal beneficiaries get a non-refundable credit for the tax that's been paid. And the franking credits received from the trust can be applied against the trustee tax. So it means you can never distribute income to anyone and it's taxed at less than 30%. Excluded from that 30% tax are unit trusts, widely held trusts, super funds, deceased estates, charitable disability trusts, and primary production income.
Now, you mentioned corporate entities. There's going to be a double taxation on distributions to those. So that's a real double whack, isn't it?
So in that example, we talked about you can distribute to individuals or corporate beneficiaries. This change means you will not be distributing to corporate beneficiaries anymore. So from 1 July 2028, you will effectively be doubling the tax you pay when you distribute to a corporate beneficiary. So the trust earns the income, pays a 30% withholding tax, distributes to the corporate beneficiary, but the corporate beneficiary gets no credit for the trust tax. And then the corporate beneficiary might frank that income out to a shareholder eventually. The end result, it's a double of the tax, up to 60%, maybe more, on that trust income. Now, I'm pretty sure they knew what they were doing and they meant to do it, but it's a shocking move.
And that just means that you'll have to find another way for your clients to be distributing their
What is
money.
it? This is day 3 of the new world, Nick. What the government wants is people to move out of trusts and transfer into companies. We don't know a lot of the detail, but there'll be rollover relief to transfer assets to a company. But my consistent experience with government rollover relief is it's often quite narrow. It doesn't work well. I mean, this move is based on the idea that, those people with trusts, they're the bad people, and we're going to close them down and do this. It's not a sympathetic environment that takes into account that people have been doing this for 50 years. It's this sort of broad labelling, and that's a real problem.
And Michael, could you expand just a little bit on that rollover relief?
The idea is you've got a 3-year window to restructure, and it starts on 1 July 2027. And it's to support taxpayers moving out of trust into companies or a fixed trust structure. So it's only for 3 years, so we need to start thinking about that now. And there's a whole lot of variety of things to weigh up. I guess the main point at this point in time is to understand there's rollover relief, and you've got a 3-year window to do it, and it starts 1 July 2027.
So taking all this into account, do these measures represent a broader philosophical shift in how the government wants to tax wealth and investment in Australia?
Yes, and the government needs to raise money, and it is taxing wealth more than it has ever before. The number of examples over the last couple of years at a state level and at a federal level. By doing it with capital gains, I think there's significant bad consequences because it discourages people taking risk and making investments. It discourages people starting up things from scratch, being creative. That's a real disappointment.
So for business owners and investors listening today, should they already be reviewing structures and investment strategies, or is it too early before the legislation is finalised?
No, I think they should start be thinking about it now. And we'll need more detail, of course, but in terms of structures, definitely we're already talking to clients about it. It's an important thing to consider.
All right, there was a lot in the budget, and we haven't got time to cover it all, but I do want to just sort of quick fire around here. 4 other business-related tax measures from the budget. I just want a quick one-line answer if you can. The first one, refunds for tax losses for eligible startups.
Okay, so that starts 1 July 2028, and first 2 years of a company's life with a turnover of less than $10 million can get some money for their losses, okay? Interestingly, the refund is capped at the FBT and PAYG withholding paid on Australian wages, which means what they want to do is encourage employment rather than the usual sort of founder or contracting basis.
But that's a good one, because we did talk earlier about disincentivising startups.
It's a good one. How big, I don't know. And I hope we'll see more startup incentives. Yeah. But look, incentives are always complicated and have strings. Why not just open it up, Nick?
Yes, it would be nice. The second one, the return of company loss carryback rules.
Okay, this is available from 1 July 2026, okay?
2026?
Yes, and it's a permanent measure. It's for companies with less than 1 billion turnover. They'll get a refund on tax paid in the prior 2 years by using current year losses. So they've paid tax on income for the last 2 years, they've got a loss. So it helps cyclical businesses, like construction, farmers, things like that, winemakers.
Yep.
It's revenue losses only, and it's capped by the franking account balance.
The third one, the permanent $20,000 instant asset write-off.
Okay, great. I mean, remember, it's been on for so many years. Look, of course it's good, and our clients really like this, but, $20,000, it's starting to be a bit too small, for capital expenditure, I think. We wanted to see more than that, and it's welcome.
Start lobbying for $40,000 next year.
Yeah, more meaningful amount. I agree. Let's start talking about it.
And the last one, in the phasing down of the electric vehicle FBT exemption.
Yeah, I'm glad you said phasing down, because often these announcements you think, oh, that's great. This one, it's great that there's something there, but it is a phasing down. So currently you have a electrical vehicle FBT exemption for the right sort of amount of cars. This is a transition. So it goes from 100% exemption to a permanent 25% fringe benefit tax discount from 1 July 2029. So the way it works is that the current rules remain until 31 March 2027, where vehicles less than or equal to $75,000, provided it's before 1 April 2029, get to keep that 100% discount for the life of the arrangement. Going forward from that, vehicles between $75,000 and the fuel-efficient LCT threshold will get a 25% discount if they're provided between 1 April 27 and 1 April 2029. Now, as a planning point, this rate is locked in at the start of the arrangement, so bringing forward novated leases before April 2029 preserves the sort of full exemption for the full length of time of the lease.
So finally, Michael, looking at the federal budget as a whole, do you think it creates confidence for the small business sector or more uncertainty? And what should business owners be focusing on now as a result?
Well, I think that it doesn't create confidence. I think it's a good one for small business. The changes that they've provided are quite small against the significant, very, very significant changes to do with trust and capital gains tax. And these are such important measures for our small businesses. So uncertainty, I think it's certainly bad for small business. So people, they've got to sharpen the pencil. They've got to start thinking. It's not the end of the world. It's just another budget, but it has serious consequences and you need to understand what it means for you and your business.
That was Michael Jones, partner at Forvis Mazars. Thanks for joining us for this week's episode. Follow Business Essentials podcast across social media and head to businessessentialspodcast.au for more. Business Essentials is a Sound Cartel podcast. Producers are Nick Schillberger, Nicole Goodman and myself. Technical production is by Pete Letts. I'm Grace Jennings-Edquist. Thanks for listening. We'll bring you more Business Essentials next week.
Sound Cartel.